Hey guys, today I'm going to talk about something that's really hot in the markets, and that's SPACs. SPACs have made up about 25% of all IPOs in the last year, and they're growing in popularity. Some of the biggest profile IPOs this year has been through SPACs, such as DraftKings, Nikola, and Virgin Galactic. So let's dive into SPACs, why they're so important, and how you can get involved and invest in them. So first off, let's answer the question of what is a SPAC? SPAC stands for Special Purpose Acquisition Corporation. SPACs are blank check companies that IPO and have the sole purpose of finding a private company to acquire within a time frame of about 2 years to bring public. SPACs are really attractive for private companies, especially during times of economic uncertainty, because when a company IPOs through a SPAC, they know for certain the amount of money that they're able to get through their IPO. In a traditional IPO, the amount of money that a company is able to raise is really dependent on market sentiment. In a time when there's rampant COVID and the markets are really tumultuous, this uncertainty is not attractive. So that's why we've seen so many companies IPO through SPACs recently. Now let's answer the question of how do SPACs work? When a SPAC IPOs, instead of selling or offering shares, you get offers of units. Each unit is comprised of one common stock and typically a fraction of a warrant. A warrant is basically the right or option to buy a stock at a certain strike price. After a SPAC IPOs, investors can buy units that ultimately will trade separately after about 52 days on the market or so that they trade as the common stock, the warrant, or units. There's some arbitrage between the price of a warrant and a common stock compared to the unit of the SPAC. Typically, you don't have to worry about whether to buy units, common stock, or warrants because the market prices them in all about the same. So there's little room for arbitrage, and you're not going to really get an edge investing in one form or another. But if you get in at a good price when you buy a unit, you're going to be holding both common stock as well as the warrant. So a SPAC has about 2 years to find a target company before it typically would liquidate its fund. When that SPAC finds the target company and they enter into an agreement for a merger, the SPAC will ultimately start trading under a new ticker, one that represents the target company. So for example, VectoIQ was a SPAC that merged with Nikola. For a while, investors were trading VectoIQ shares because the Nikola VectoIQ merger hadn't been completed. However, once the merger was completed, the VectoIQ shares were renamed to Nikola. So any returns you got from your VectoIQ units, shares, or warrants, you'll maintain those returns even after the ticker name has changed. So let's break down the advantages and disadvantages of trading SPACs. To begin with the advantages, when an investor trades a SPAC, they typically understand what their downside risk is. What I mean by this is that when a SPAC doesn't acquire a company within the 2-year time frame and decides to liquidate its fund, you'll at least be making back $10 a share from the SPAC. Investors may lose the premium they paid for the SPAC, but overall, at least investors are aware of what their downside risk is. Secondly, if an investor doesn't like the target company that the SPAC has identified, they're able to redeem their units for $10 a unit. So again, this is a way for investors to understand the downside risk is capped at $10 a unit, and you may lose whatever premium you paid for the unit. The biggest advantage of investing in SPACs is that SPACs will typically try and target a high potential company. A lot of early stage, forward-looking companies are afraid of the typical IPO market because they don't have the balance sheet or income statement to support their valuation. However, with a SPAC, they're able to raise a set amount of capital and are not worried about market sentiments or their lack of strength on their balance sheet or income statement. This is how companies like DraftKings, Nikola, and Virgin Galactic went public. And then what happened was a lot of public investors decided, hey, these guys have a lot of potential in the future. I'm going to put my money in them and wait for the long run. And that's why we saw returns upwards of 700% in the case of Nikola coming out of these SPACs. Now let's talk a little bit about the downside risk, because there certainly are downsides with SPACs. When you invest in a SPAC, especially early on, it's great that you're getting in at $10 a unit, but it may take up to 2 years before the SPAC identifies a target company to acquire or merge with. Now that 2 years is opportunity cost where your capital really isn't gaining any value. That's something that you have to keep in mind. Another disadvantage is the situation where a SPAC is not able to find a target company within that 2-year time frame. What will happen then, like I mentioned before, is that the SPAC will liquidate its fund and pay back all the shareholders or unit holders $10 a unit. Now, a lot of SPACs actually trade at a premium because those SPACs are managed by high-profile names, such as Goldman Sachs. There's an upcoming one by Bill Ackman, etc. So a lot of investors may actually lose 10%, 20%, or whatever premium they paid for in the situation the SPAC does not identify a company. The third downside risk is we're now entering a time when there are a lot of SPACs on the market. Like I mentioned, 25% of IPOs in the past year were actually SPACs. What this means is the more SPACs that are on the market, the harder it is to find a good company for those SPACs to target because there's more competition. So now we're put in this position where these SPAC investments are likely a little bit more risky because there's a higher chance they're not going to find the target company that's going to bring significant returns. That's something else to keep in mind. So just to wrap up, when investing in SPACs, you have to consider each SPAC individually because not all SPACs are made the same. Some SPACs raise a marginal amount of money, such as $100 million, to acquire a really small company, while other SPACs, such as the one that Bill Ackman is IPOing right now, is going to raise upwards of $4 billion. That means they're targeting a company that might be as much as $10 billion to bring public. And also, in those situations, Bill Ackman actually has a SPAC where it's $20 a unit, and the units have different rules and regulations. So make sure to do your diligence on each SPAC before you invest in them. And as always, diversify your portfolio. It's the best thing to do because while SPACs have significant upside, like we saw with Nikola, DraftKings, and Virgin Galactic, there is significant downside potential as well. So do your research and make educated investments. As always, don't hesitate to reach out to our team here at WX Capital. See you around. If you guys liked our video, don't forget to like, comment, and subscribe. Also, check out our website at www.wx.capital. We have a great subscription service that allows you to get real-time trades as well as market commentary, so you know exactly what's going on with stocks and you know exactly what we're trading and what the next hot stock pick is. See you guys around.